Canada's central bank just held interest rates steady, again. But with inflation at 3.2%, a housing market out of reach for millions, and a trade war still lurking, is holding the line enough? This is your Canadian economic briefing for July 2026. On July 15, 2026, the Bank of Canada held its overnight rate at 2.25%, marking the sixth consecutive hold. The decision signals that policymakers believe the economy needs more time before rates can move again. But it also reflects a deeper tension: Canada is growing, just barely. Canada's inflation rate climbed to 3.2% in May 2026, well above the bank's 2% target. The main culprit? Gasoline prices. With the conflict in the Middle East pushing global oil higher, Canadians are paying more at the pump, and that's rippling through everything from groceries to construction costs. The bank projects inflation will ease to 2.5% by the second half of 2026, but Canadians have heard that before. Before we continue, this analysis is brought to you by Gerard McMann, Canada's AI-powered investment platform. Whether you're trading equities, options, futures, or crypto, Gerard McMann's AI tools help you make smarter, faster, and more informed decisions. Not to replace your judgment, but to sharpen it. Explore the platform at gerardmcmann.com. But inflation isn't the only pressure Canadians are feeling. Housing has become a defining crisis. Since 2000, Canadian home prices have risen 355%, while median incomes grew only 113%. Nearly 1.5 million Canadian households are in what's called core housing need. And the US tariff uncertainty made things worse. Home resales fell nearly 10% from January to February 2026, the biggest monthly drop in 3 years. Canada's trade situation remains complicated. The CUSMA Joint Review, the agreement that governs trade between Canada, the US, and Mexico, concluded on July 1 without a renewal deal. The agreement remains in force until 2036, but the uncertainty created during negotiations has already had an impact. Meanwhile, Canada posted a merchandise trade surplus of $4.2 billion in May, a sign that exports are holding up despite the headwinds. In the middle of all this uncertainty, Canada's labour market delivered a small but meaningful win. The economy added 18,000 jobs in June 2026, bringing the unemployment rate down to 6.5%, a 5-month low. Youth unemployment also dropped to 12.7%, down from a peak of 14.6% last September. It's not a boom, but it's movement in the right direction. So where does Canada go from here? The Bank of Canada expects the economy to grow 1.8% in both 2027 and 2028, a notable improvement from today's 0.7%. Inflation is projected to fall back to 2% by early 2027. But between now and then, Canadians will need to navigate high housing costs, a still fragile labour market, and ongoing trade uncertainty with Washington. The rate hold was the bank's way of saying, "We're watching, and we're not done yet." Canada is at an economic crossroads, and the decisions made in the next 12 months will shape the financial landscape for millions of Canadians. At Gerard McMann, we give Canadian investors the AI-powered tools and education to navigate exactly these kinds of moments, whether you're trading equities, building a retirement portfolio, or watching the macro picture. Visit gerardmcmann.com to explore the platform. Subscribe to this channel for weekly Canadian economic analysis, and drop a comment below. Do you think the Bank of Canada made the right call?